Okay, it's 8-4. Just want to cover positioning for the 5 funds noted in the description. MSTY PLTY NVDY CONY and HOOY are the ETF for Robinhood. So I guess jumping into it, I'll start with MSTY because that's the most widely held fund. But yeah, I guess I refreshed all the tables. You can see 8/8/2025 is the new fund or the new call ETF expiration date. So the two things I like to cover, just where they got their call options written. Also take a look at how their ETF price is funding over time and which components are accounting for that. So to start off with MSTY, looks like we got most of the calls sold right here at the 390 strike price, then up in increments of 2.5, 39, 392.5, then 395, then 400. And then we got some bought, or the big part of our credit spread is here at the 420. So if MSTY does rise, I guess we would be somewhat inclined to see it shoot past this 420, then we would capture the upside again. But then we have a few more written here at 425 and got some other kind of insurance at the 422.50, 430, and the 457.50. And then so that's a look at the funds. And then as far as how it's made up per share, MSTY did have a decline the other day. I'll show this in another chart as well. But the ETF price currently sitting under 20, right around 18. It has more cash than the ETF's worth. As far as why, well, you got a negative position on the contracts you sold. And then the synthetic is also driven into the negative value based on a negative beta correlation to the MicroStrategy or strategy underlying stock. If you want to see how that has fluctuated over time, I guess I made this new image here that basically shows in green here the ETF price. Blue's the cash, which stays pretty constant. The only time the cash really moves is when they sell their contracts on a weekly basis. You'll get more cash because cash comes into the ETF when you sell them, and then hopefully those expirations expire worthless. So that obligation starts with a negative value, but then progresses to zero if it expires worthless. Those other contracts are noted here in yellow, how their value fluctuates over time. They start off negative and then hopefully go to zero. If the underlying shoots past the contracts, the yellow line would probably go to a positive, or you want it to shoot to zero. If it zooms higher, the yellow line will become more negative, representing a bigger drag on the ETF because you sold a call option that the underlying ETF zoomed by. And apologies, I just clicked previously I didn't have the last 3 dates inserted in here. So you can see the ETF price of MSTY has gone down quite a bit. You can see what's driving it. So the cash position, it increases when you sell the other contracts, but then it decreases when they just paid their distribution. So that all comes out of the cash. So you can see over that day when it went ex-dividend, the cash position dropped by how much they paid per share. And then as far as the ETF price here in this light bluish color, you can see it declined somewhat rapidly the last few days. And as far as what components driving it, not the cash actually went up a little bit. The other contracts didn't move that much, but you can see like the synthetic is what drove the decline in the ETF price. So the ETF price here is almost 100% tracking kind of that synthetic, at least for this day. But yeah, I like this chart just to show you why the ETF price for this, what do you call that? Like a teal color? Maybe I should change that. Why it's changing, how it's changing, and what components are affecting its change. But that's a MSTY for the fund update, 8/4/2025. I'll jump into Palantir here. Palantir is part of Group B. So if we go in there and go to the PLTY details for PLTR, the underlying stock, and we go to the positioning. So once again, the red line is the synthetic. The black line is where the stock price is at. It might have changed a little bit today, but this was as of the end of trading day at the end of the week. But you can see 8/8/2025, we got all the calls sold here at 165, 167.50, and the 170 strike prices, with insurance on the upside starting at 177.50. As far as how the fund is made up right now, ETF price approximately 67.61. What's that made out of? You got your cash at 62.20. You got the synthetic value, which is pretty good at 662 per share. And then the other contracts which are sold out are currently acting as a negative $1.20 drag on the fund. As always, if they are not hit, and they expire worst list, this will go to 0 and therefore pushing the ETF price up by $1.20 a share. Just how they're looking at their collateral right now, they got a synthetic that allows them collateral of 39,207 contracts. They have insurance, or they have credit spreads issued on all those. So 100%. When I say insurance, what I mean, for every call that they have sold, they have another call at a higher strike price bought. The ratio right now is 1-to-1 because they got 100% insurance. So if Palantir were to run by the end of the week above 185, you would be capturing 100% of the upside from 185 on because you got those insurance contracts structured in there. And then I guess to dive into how their fund has performed over time, making sure I got all the checks checked so I'm not missing any dates. But you can see the synthetic going up and down as the underlying stock price goes up and down. The cash just recently here, it shot up from, I guess, 61.12 to 62.20. Why is that? Because they sold more contracts. You can see they went from negative 38 cents to a negative $1.20. So by selling those contracts, you get the cash up front, which pushes your cash word up. As far as the ETF price, that, declined mainly just because the synthetic went down with the overall down market. But so that's Palantir. Next one would be NVDY for those interested. I did list them in the title, way in which I intend to cover them, so you can jump to wherever you want to go. But the thing I noticed, I guess, right off the bat for NVIDIA is that they got this old contract in their data for some reason. I'm not sure why that's there. I assume that's 0, but since they got it in their data that they publish on their website, I have it included. But for the 8 contracts that they have sold, or maybe first they got a synthetic structured at 165 and 170. Stocks currently, or was about 175 as when I pulled the data. Most of their contracts they have sold at the 187.50 and the 180 strike prices, with a couple other ones kind of splashed between there. Then their insurance starts at 190 and goes up to 197.50. As far as how they're made up, they do got some money in that synthetic, 72 cents a share. The contracts they sold right now act as a negative 6 cents per share on the fund for the week. And then in terms of how they're structuring, they got 107,640 contracts that they have that they can use as collateral. They've issued all of it they've written calls against all of it because they got no remaining capacity. Against that, they do got insurance on 99,385, so they got 92% insurance, or I guess 92% of the calls they wrote did come with that extra credit spread leg to them where they bought a call at a higher strike price. As always, I'm not going to hit all these, but you can see how the fund's been doing over time. You can see like what percentage of their, so if you see that one data point that says shares percent total, it says that 31% and 31.7% of the shares that got sold are at the 180 strike price. This one's 37% because you can see the bars a little bit bigger. You can also read it by looking at the numbers in the y-axis here. And then if you're interested at all, and if you're not interested in how many contracts they have sold, but rather the value of those contracts, that's the point of this metric here. You can see at the 180, where they had one of the most strike price with the most contracts sold, but in terms of value, it's negative 4.2 million or 3.8 cents per share. You can see that some of the other strike prices are a little higher. They have a lot of shares as well, but because they're out further in terms of strike price, you're not necessarily worth as much. So the closer you get to the strike price, or the stock price, I should say, the more valuable they are, even if they could contain less contracts. So I guess jumping over to the holdings versus time, and once again, make sure all the check boxes are marked. So if you're interested in a certain time frame, you can clearly adjust this as needed to take out those data points. But if you include them here to see a full kind of how the fund's been performing since July 22nd, 2025. Pretty steady, I guess. The cash value stays about same. NVIDIA hasn't paid in this time frame, so you don't see that go down to adjust for payments. They continue to write some calls to generate a little bit of cash, and then overall the synthetics kind of been dictating where the NVIDIA or NVDY ETF price goes over time. Okay, there's NVIDIA. I'm going to jump to a couple of Group C holdings, so CONY as well as HOOY. So in terms of CONY, I guess if we jump into the in-depth metrics, so you can see, first of all, you can see the market cap's gone down. That's driven mainly because Coney reported earnings and the stock dipped 10% plus. So therefore, obviously it had an impact on Coney, the underlying, or the Coney ETF. But as far as what we got written, here's another instance where their data, for some reason, it has this data point out here from 8/1. This it's clearly 8/4, so this is expired, so this shouldn't be in their data set anymore. Not sure why it is. It'll probably be out tomorrow, and the data set will adjust accordingly. But it looks like they still got that synthetic at 390, even though the stock price is well below that. A good look at what Coney is, or what Coinbase is, the actual underlying equity. So it looks like it's in the 310 to between 310 and 320. So you can see it's quite a bit below the synthetic. So clearly the synthetic is a large negative on the fund at the moment. As far as the calls they have written out for the week ending in 8/8, most of them are at the, let's see, the 390 strike. They start at the, sorry, I read that wrong. 338 strike. They start at 328 and go all the way up to 340. Then they got some insurance bought in case there's a big snapback, starting at 353 and going up to 360. And as far as fund makeup per share, as I noted, yeah, that synthetic took a hit with the underlying equity going down following earnings. So you can see, even though they got about $9 in cash, ETF price is in the sevens, driven by that negative synthetic value of almost $1.65. And the other weekly contracts they have sold that equate to 7 cents per share right now, drag on the ETF price. I think that's what I wanted to cover as far as Coney. I think people own it and realize that Coinbase stock fell. And you can also see this fund holdings over time. So here was their cash, here accordingly, or as I stated before, when the cash drops, that's when they paid that distribution. So you can see their cash holdings fell. Cash holdings have remained somewhat constant. You can see they go from $8.92 per share up to $9.02 per share. That was all driven by just selling those weekly contracts accordingly. As far as the ETF price, that declined from in the high eights to basically the low to mid sevens, driven entirely by the underlying equity or the synthetic value. You can see that dropped somewhat large. So that obviously drove the ETF price. For those who are interested in that, that is why it fell. Probably know that, but you can see the data suggesting it as well. And then the final one, also in Group C, Robinhood. So Robinhood details for the week. They got their synthetics 80 and 90. Clearly the stock price is above those. So the synthetic is offering a positive impact to the actual ETF price, as the stock price is, I think it's actually above 101, about 104 or so right now. So a little bit above that, where it was at the beginning of the day. But they got contracts sold at 100, 101, 103, 106, 107, and most of them at the 109 strike, and then some more at the 110. What's interesting is they got a lot of strikes, a lot of calls also bought at the 108. If it passes these metrics here, at 108, you actually start gaining again. It gets on 5,500 contracts. But then you also got 5,000 sold at the 109. That's an interesting kind of strategy there. And then they got more bought at the 117 and all the way up to 120. As far as the funds, or let's take a look at the synthetic. So they got 21,780 shares that they can use as collateral, or I should say contracts. They're using them all. So they got call options sold on all those contracts, representing all of them. But then they also got calls bought at higher strike prices for all of them as well, giving them 100% insurance. And then for the fund makeup per share, as I noted, the synthetic is adding roughly $9.20 to the ETF price. The other contracts they have sold right now is acting as a negative 84-cent drag on the week to the ETF price. So if they're not hit, it adds 84 cents. We'll see how the week goes. But then finally, just the fund holdings versus time. Let that update itself, and nothing really to point out too in depth. Cash for the time frame, I have noted that it haven't paid a distribution in that time frame. So the cash is going up slightly. What's it going up from? It's going up from these yellow here, which represents the weekly contracts they're selling to generate modest income. Or I say modest, but over time it does add up to quite a bit. And then they also got their synthetic here, which is just going up and down with the markets, which is primarily driving the ETF price up and down. Yeah, so I think that's what I want to cover on those 5 YieldMax ETFs. Hopefully you find it useful if you want to really understand the in-depth details of how these funds are structured, how their different components are moving. And of course, when I say they're different components, what I mean is the ETF price is built of 3 components. It's built of their cash position, their synthetic position, and the weekly contracts they sold to generate that weekly income. Those 3 basically added together come up with your ETF price. So the big moves in the ETF price are usually driven by the underlying equity, which really impacts the synthetic position. And then these other contracts are usually start off negative to begin the week and then hopefully dwindle down to 0 at the end of the week if they're not hit. But if they are hit and you blow by them, that can still be okay because you're losing money there, but your synthetic's gaining value. So not the worst case to have the underlying equity go up in all situations. But yeah, that's an update. Thanks for tuning in.